top of my head, I would say having no clue about where the implied vol is in its ranges and what the risk attached is to the implied vol collapsing when you go and buy an option to express a directional view, right? So one thing, you'll often get a situation where markets will drop and implied vol will go up a lot, and then people who are bullish will go and blindly buy calls, but not have a clue that those calls are on such an elevated vol that even if their view on the market is right and we get a bounce, because of the way the vol collapses, they make no money, basically, right? So understanding the interplay between the Greeks in the option expression that you're choosing, and knowing that when spot moves, vol moves, and what is the likely direction of that, and how is that going to impact the premium of your implementation of your trade, right? So that's a very common mistake: buying calls, thinking they're going to work in a bounce, and then they make you no money. Very common. Also buying too short dated an option as well, right? If you've got a view because the market's had a pullback or whatever, you want to buy the dip. That's usually not a great idea, because by going too short dated, you're just making the odds of success lower, right? You need to be right, and you need to be very right, right? You'd rather pick something that kind of buys you a bit more time and allows you to be not perfect with your timing, and you might be off by a week or two, but because you bought yourself a bit more time, your trade comes good, basically, right? So I think that's another mistake novices make. They go too short dated. So the last mistake that people make is that, it's okay to sell options, right? First of all, some people are too scared to sell options, and you do need a bit of margin to sell options. But once you get your head around selling options, right, you need to know that options can explode in value against you, right? So you don't want to be the guy who sells an option for 10 and it's worth 200, basically, right? So when people buy options because they give them leverage, right? But when you sell options, you need to know that that leverage works against you, right? So whilst it's okay to sell options because they look expensive and they look juicy and it looks like the vol's expensive and it's going to go down and you want to earn time decay and all these things that are great, also know that when you get it wrong, that option can multiply against you fast. So the way I do it, because I sell options, I either sell spreads, so I sell call spreads or put spreads, so I've got a defined loss that I know can't be too big, okay? Or I sell an option and I give myself a stop. And I say, if that option doubles in value against me, I'm getting out. Yeah. So the most I'll ever lose on it is 1 times the premium. And it will never be one of those things that just snowballs on me, right? So if I'm right and I earn the time decay and it's great, fine. But if I'm wrong, I'm willing to draw the line in the sand and have a stop on that, right? And I think that's something people kind of don't necessarily always do if they're not experienced. Because experiences teaches you these lessons, right? I've lost money before by selling a call that suddenly exploded in my face, right? And I'm never going to do that again, right? So it's through experiencing those losses and those pitfalls that you know what to avoid, right? And so now whenever I sell call options, because I think the market's a bit toppy, and I buy puts and I try and be bearish, and then the call doubles in value, I cut it and I move on, right?